shall now discuss about bills of exchange. Let us first understand the definition of bills of exchange as per the Act. A bill of exchange is defined as an instrument in writing signed by the maker containing an unconditional order directing a certain person to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. So, this definition is very important. So, what you have to understand is the significance of the words used in the definition. One is, it is an instrument in writing, that means it has to be always in writing. Oral thing will not make it a bill of exchange. It has to be signed by the maker of the bill of exchange, that means the person who is drawing the bill has to sign the bill of exchange on the face of the bill. So, it contains an unconditional order. It is an unconditional order, that means there are no conditions attached to the order directing a certain person, that means the maker of the bill directs a person to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. So, it can be either a bearer or to the order of a particular person. So, there the person has to be certain, that means it cannot be a fictitious person, it has to be a certain person, and the sum of money also should be certain, that means it cannot be ambiguous. So, these three words are very important. One is an instrument in writing, second is directing a certain person to pay a certain sum of money. It can be either paid to the order of that person or to the bearer of the instrument. So, from the above definition we can conclude that there are three parties to the bill of exchange. Three parties are called the drawer, the drawee and the payee. Drawer is the person who draws the bill, that is who makes the bill. Drawee is the person on whom the bill is drawn, and payee is the person who is going to receive money, that is the beneficiary of the bill, that is called the payee. So, we can look at the board and see how a bill of exchange looks like. A specimen of bill of exchange is given. It is signed by ABC, that means he is the drawer of the bill, and the date is also mentioned on the bill. It is addressed to XYZ, that means it is made on a certain person, and there it says 3 months after due date pay to PQR, that means ABC is directing XYZ to pay to PQR, that means he is asking him to pay to PQR or order, it can be to the order of PQR also, the sum of rupees 1000 for value received, that means the certain sum of money is mentioned, that is rupees 1000, and it is accepted by XYZ, that means XYZ accepts the order given by the maker of the bill of exchange, that is ABC, that he will be abiding by that unconditional order to pay the money to PQR on the due date. So, only when it is accepted by the person on whom the bill is drawn, it becomes a proper bill of exchange. That means, without acceptance of the other party, it has no validity. Only one person drawing a bill does not make it a bill of exchange. The other party on whom the bill is drawn has to accept it. That is called acceptance of the bill of exchange. A bill of exchange can be passed on to another person by endorsement. What is the meaning of endorsement? Endorsement means transfer of the property in the bill of exchange by signing on the face of the bill of exchange or on the reverse of the bill of exchange. That is called endorsement. So, that means once the person in whose favor the bill is drawn signs it on the back of it and makes it payable to somebody else, in which case he is transferring the bill of exchange to another person, that is called transfer by endorsement and delivery. Once it is signed, it has to be delivered to the person in whose favor bill of exchange has been transferred. So, the primary liability in the case of a bill of exchange is that of an acceptor. The person who has accepted the bill of exchange has accepted the unconditional order made by the maker of the bill of exchange. So, it is his responsibility to make payment of the sum of money to whoever person who is entitled to receive the money. If he does not pay, a holder can recover amount from any of the previous endorsers or the drawee. That means, if the holder of the bill of exchange has recourse to other parties involved in the bill of exchange, first of course he will have to recover it from the acceptor of the bill of exchange, if the acceptor does not pay, then the persons who have endorsed the bill prior to him or the drawer of the bill will become liable for the amount to the holder of the bill. So, in the case of promissory notes, let us see what is the difference between a promissory note and a bill of exchange. For that, let us understand the definition of a promissory note. A promissory note is an instrument in writing, not being a bank note or a currency note. It is not a bank note nor a currency note, containing an unconditional undertaking signed by the maker to pay a certain sum of money only to or to the order of a certain person. So, here like a bill of exchange, it is also an instrument in writing. That means it has to be put in writing. It is not a bank note nor it is a currency note. It contains an unconditional undertaking instead of unconditional order. In the case of a bill of exchange, the drawer gives an unconditional order to somebody else to pay the money. Here the person who is drawing the promissory note undertakes himself to pay the certain sum of money. Here also the sum of money is certain to or to the order of a certain person. That means the money becomes payable to somebody else or to the order of that somebody. So, both the person who is making the promissory note and the person to whom it is payable are certain persons, and it is also a certain sum of money. A promissory note cannot be made payable to a bearer. Unlike in the case of a bill of exchange, a promissory note is always payable to the person or to his order. So, there are two parties in the case of a promissory note. One is called the maker, the second is called the payee. The person who makes the promissory note and promises to make the payment is called the maker of the promissory note. That means he is the person who is responsible to pay the money mentioned on the promissory note, and the payee is the one who has to receive money. That means he is the beneficiary of the promissory note. So, just like a bill of exchange, we can also study how a promissory note looks like. On a board you can see the specimen of a promissory note. There you see it is been made by XYZ, his name appears on top of that, the date also appears, and he is promising. It says 3 months after date I promise to pay PQR or his order a sum of rupees 1000 only for value received. So, he is himself promising to make the payment of rupees 1000 to PQR, and it is addressed to PQR. There is no question of acceptance of PQR, it has to be signed only by the maker of the promissory note. So, the moment XYZ signs it, it becomes a valid promissory note. There is no need for the other person to sign because he is the one who has to receive the money. Whereas, in the case of a bill of exchange, an acceptor has to accept before it becomes an actual bill of exchange, because the acceptor is the person who has to make payment. In the case of a bill of exchange, here the maker of the promissory note himself is the person who has to make payment. So, now let us try to understand what differences are there between a bill of exchange and a promissory note. So, first of all, we have seen that a bill of exchange is an unconditional order to pay, whereas a promissory note is an unconditional promise to pay. So, that means in the case of a bill of exchange, the drawer of the bill is making an order, unconditional order to somebody else to pay the money mentioned on the bill of exchange, whereas in the case of a promissory note, he himself, the maker of the promissory note himself, makes an unconditional promise to pay on a particular date a certain sum of money to a particular person or his order. So, one is a unconditional order to pay, the other is an unconditional promise to pay. And second is, in the case of a bill of exchange, it is made by a creditor. That means the person who has to receive the money draws the bill, and the person who has to make payment is called the acceptor. In the case of a promissory note, it is made by a debtor. It is the person who has to make payment makes the promissory note, whereas in the case of a bill of exchange, it is the person who has to receive the money who draws a bill of exchange. And third point is, acceptance by debtor is necessary in the case of a bill of exchange. That means the other party has to accept the bill before it can be called a valid bill of exchange. That means the person on whom the bill is drawn has to accept his liability to pay a certain sum of money on a particular date to a certain person or his order. Whereas in the case of promissory note, no acceptance is required, because the person who is making the promissory note himself is the person who has to pay the money. Since he has already signed the promissory note, there is no need for acceptance by anybody else. And the fourth point is, as we have seen, there are three parties to a bill of exchange, that is the drawer, the drawee and the payee. Whereas in case of a promissory note, there are only two parties, that is the maker of the promissory note and the payee. And the last one is on the dishonor of a bill. That means when the bill is not paid on the date it has to be paid, it is usually noted by a notary public. That means there is a process of noting the bill of exchange before any further action can be taken on the dishonor of a bill. But in the case of a promissory note, noting is not considered necessary. So these are the important points on which a bill of exchange differs from a promissory note. So there is another negotiable instruments as per the Negotiable Instruments Act, that is called a check. All of you are familiar with the check. So according to section 6 of the Negotiable Instruments Act, a check is a bill of exchange drawn upon a specified bank and payable on demand. So these are the essential differences between a bill of exchange and a check. It is a bill of exchange drawn on a specified bank. That means it is drawn on a specified bank, whereas bill of exchange can be drawn on anybody, and it is payable on demand. So whenever money is demanded, it is payable on demand. So the features of a check are as under. First of all, it must fulfill all the essential elements of a bill of exchange. That means since it is a bill of exchange, whatever we discussed in respect of a bill of exchange must all be present in the case of a check also. It must be payable to bearer or order, but in either case it must be payable on demand. It must be payable on demand, not at a particular date. That means whenever it is presented, it should be paid to the person who is the bearer of that check or the person in whose favor the check has been made out. The banker on whom it is drawn pays it when presented for payment. So when the check is drawn, the bank on whom it is drawn always pays the value of the check when it is presented for payment. It must be dated. There must be a date on the check. The signature of the person who is drawing the check must tally with the specimen signature of the drawer, which is normally kept in the bank. So whenever bank receives a check, it usually tries to verify the signature of the drawer of the check, and only when it tallies can the check be paid by the bank. May be drawn with a future date. That means it can be post dated, but it becomes payable only on after the specified period. Suppose it is drawn after for a date after a month, it can be presented to the bank only after that date. It cannot be presented before the date. So post dated checks can be issued, but they cannot be encashed before the actual date. So now we will try to find out what are the essential differences between a bill of exchange and a check. First of all, a bill of exchange can be drawn on any person including a bank. So bill of exchange drawee can be anybody. It can be a bank, it can be any other person. Whereas a check is always drawn on a bank. It can be drawn on a specified bank only. It cannot be drawn on any bank, on a specified bank. A bill of exchange requires acceptance, whereas a check does not require any acceptance. There is no acceptance of the person who has to pay the money. The third point is the acceptor is allowed 3 days of grace after the maturity of the bill. So once the bill matures, there is a time given to the payer of the bill of exchange to pay the amount within a period of 3 days, and these 3 days are called the grace period. So there is always a grace period of 3 days in the case of a bill of exchange, whereas a check is always payable on demand. So bank cannot say that they will pay after 3 days. As and when the check is presented, it should be paid subject to certain requirements being met. A bill of exchange must be stamped. There is a stamp duty on a bill of exchange is mandatory, depending on the stamp duty to be paid in a particular state, whereas a check does not require any stamp. That means no stamp duty is leviable on the drawing of a check. In the case of a bill of exchange, as we have seen, notice of dishonor of the bill of exchange is necessary, whereas in the case of a check, no such notice of dishonor is necessary. And before we go as to how to put the entries in case of bills of exchange, when they are presented, when they are issued, or when they are accepted, when they are dishonored, we have to find out certain important terms which are used in a trade involving bills of exchange. So, normally we use the following terms. One is called the holder of the bill of exchange. The holder of bill of exchange is the person who is legally entitled to receive money on due date. That means anybody holding the bill of exchange, if he is holding that bill of exchange legally, he is the person legally entitled to receive the money under the said bill of exchange. So, he is called the holder. A holder in due course is defined as a holder if he satisfies the following conditions. That means a holder of the bill of exchange becomes a holder in due course subject to his satisfying the following conditions. They are: has obtained the instrument for valuable consideration. That means he has come into possession of the bill of exchange for valuable consideration. There must be some consideration involved in getting that bill of exchange. If there is no consideration, then there is no question of his becoming a holder in due course. Second important condition is has become the holder of the instrument before its maturity. That means he must have come into possession of the bill of exchange before the bill of exchange has become mature. That means before the maturity date of the bill of exchange. And third is he had no cause to believe that any defect existed in the title of the person from whom he derived his title. That means the holder of the bill of exchange should not have any suspicion that there is no clear title of the person from whom he has received the bill of exchange. Therefore, if the bill he has received, even if it is a fraudulent bill, or even if the person who has transferred the bill to him does not have a valid title, he will still be called a holder in due course, because at the time when he received the bill of exchange, he had no reason to believe that any defect existed in the title of the person from whom he has received the bill of exchange. If all these three conditions are met, then a holder of the bill of exchange becomes a holder in due course. If these conditions are not met, a holder of the bill of exchange will not become a holder in due course, and therefore he will not get any protection which a holder in due course is entitled under the Negotiable Instruments Act. And bill sent back for collection is the bill sent to the bank for collection on behalf of the holder of the bill. Normally, bills are collected by the banks on behalf of the holders of the bills. So, such bills are known as bills sent to bank for collection. Honoring of a bill means payment of the drawee of the bill on due date. Whenever bill amount is paid on the due date, it is said that the drawee of the bill has honored the bill. So, honoring of the bill of exchange means payment of the bill on the due date. Dishonoring on the other hand means that the bill has not been paid on the due date. So, any refusal to make payment on the due date is called a dishonor of the bill. So, and another term which we normally used in bank is called a discounting of the bill. So, what is the meaning of a discounting of a bill? In the case of a discounting of a bill, the holder of the bill goes to the bank, gives the bill to the bank and asks the bank to pay him money on the strength of the bill of exchange. So, any money which he gets from the bank before the due date of the bill is called a discounting of bill by the bank. So, it is a facility extended to the people who are holding the bills of exchange. The retirement of bill normally means payment by drawee before the due date. So, honor of the bill is different, retirement of the bill is different. Retirement of the bill is always before the due date, whereas honoring of the bill is on the due date. Renewal of a bill is acceptance of by drawer of a request made by drawee to draw a fresh bill on due date as he is unable to make payment. So, normally what happens, if the drawee is not able to make payment on the due date, he may again request the drawer of the bill to draw a fresh bill for the amount and with a different due date, so that he will be able to pay it on that particular date. Such a thing is known as renewal of a bill. That means the old bill is cancelled and the bill is renewed. That means a fresh bill is issued with a fresh due date. Accommodation bill, normally most of the bankers are aware of this, is a bill drawn without any consideration. That means these are no underlying transaction when a bill is drawn. That means there is no trade involved between the buyer and the seller. He is only drawing a bill to accommodate himself to get finance from the bank. And noting of a bill of exchange means noting by a notary public on a separate piece of paper the fact of the dishonor of a bill. So, whenever a bill is dishonored, it has to be presented to the notary public, who will note it on a special paper, the fact that the bill has been dishonored on the due date by the drawee of the bill. Such a thing is known as noting of the bill of exchange. It is necessary for further action in the case of a dishonor of a bill. A rebate is an allowance given to drawee when the bill is paid before the due date. So, when the drawee is ready to pay the amount before the due date, some amount of allowance is given to him because he is paying in advance. So, that allowance is known as the rebate on the bill of exchange. Now, let us find out how the accounting entries are passed both in the books of the drawer as well as in the books of the drawee. Let us start with the accounting entries to be passed in the books of the drawer. So, there can be different situations. We will take each one of them and try to find out how the entries are required to be passed. First of all is when a bill is received in the books of the drawer. So, what normally happens is, in the case of a drawer, he draws the bill and then it is sent to the drawee of the bill, who accepts the bill and sends it back to the drawer. So, as soon as an accepted bill is received, then he has to pass entries in his books. Until that time, no entries need to be passed. Only when the bill is received, that is on receipt of the bill, and if the bill is retained in the sense the drawer keeps the bill with himself. He does not take it to the bank for discounting, or he does not endorse the bill. In which case, what entries he has to pass is, he has to debit the bills receivable account and credit the account of the acceptor of the bill. So, why this is done? Why the account of the acceptor of the bill is credited? For that, you have to understand how the entry has been passed when the goods were actually sold by the drawer of the bill to the person, that is to the buyer. So, when he sells goods on credit, normally sales account is credited and that person's account is debited. That means the entity has to receive money from that person. After that, the bill is drawn and he accepts the bill. So, whatever debit is there in his account has to be compensated, that means adjusted by crediting the account of that person, and a new head is opened under the name bills receivable account. So, that will become a asset of the entity. It will appear on the balance sheet of the entity on the asset side under the heading current assets. So, that bills receivable will get replaced by the sundry debtor column. So, on the receipt of the bill, you have to debit bill receivable account and credit the acceptor of the bill, that is the buyer of the goods. And if the bill is discounted, after that he can go to the bank and he can discount the bill. That means the bank gives him money after deducting what is known as a discount. So, he gets cash of a particular amount and simultaneously discount account also has to be debited. So, cash account is debited with the amount of the bill and discount account is debited with the amount of discount. So, cash account will be debited with the amount of the bill minus whatever charges bank has recovered in the form of discount. So, the total of these two debits will be equal to the amount of the bill, and that will be credited to the bills receivable account. So, the moment the bill is discounted, the balance sheet will not reflect the bills receivable account, that goes off the balance sheet. So, what we have now is only the increase in the cash balance of the entity. Why this happened? Because the bill has now been sent to the bank. So, he no longer has to receive the money from the acceptor of the bill, because the acceptor of the bill will now pay the money to the bank. So, it will no longer appear in the balance sheet of the entity. And when the bill is sent for collection to the bank, that means instead of getting it discounted, he merely sends it to the bank and asks the bank to collect the payment on the due date. In that case, what is debited is bank for bill collection is debited and bills receivable account is credited. so that now it will appear in the books as a bank for bill collection, so that he can keep track of all the bills sent for collection or noting the actual payment when they are received. Or instead of sending it for collection, he can also send it to another person. That means he can pass on the property in the bill of exchange to another person by endorsing it and by delivering the bill to a third party. Let us say he endorses the bill to C, in which case C's account has to be debited and bills receivable account has to be credited. That means now he has to receive money from C. That is why C's account is debited. And what happens on the due date when the bill is accepted and paid? On acceptance of the bill, A's account is debited and bills payable account is credited. This is in the books of the drawee. So as soon as the drawee of the bill receives the bill, he accepts the bill and sends it. The moment he accepts the bill, he has an obligation, he has a liability to pay the amount to the person who has drawn the bill. So if he is called A, then A's account has to be debited. That means this is the amount payable to A, and bills payable account is credited. That means that becomes the liability. So A's account gets closed, and when the bill is actually paid, whatever liability is created in the form of a bill payable account has to be reversed. So bills payable account is debited and cash or bank account is credited, depending on how the money has been paid, either in the form of cash or through the bank. Again, when the bill is paid on due date, what happens? Let us find out what happens in the case of a drawer, how the entries are passed in the books of a drawer. So when the retained bill is met, for that you have to go back to what we had done when the bill was received by the drawer and retained with him. What he had done that time was he had debited bills receivable account and credited the drawer of the drawee of the bill, that is the acceptor. And therefore now when he receives the payment, the bills receivable account has to be reversed. That means now we have to credit bills receivable account by debiting cash account or bank account, depending upon how the money has been received, how the payment has been made on the bill. And when the payment in the case of a discounted bill is made, that means on the due date, the acceptor of the bill makes payment direct to the bank. So what happens in the books of the drawer? No entries need to be made in the books of the drawer, because the drawer has already passed the necessary entries at the time when the bill was discounted with the bank. And when the bill is actually paid, he need not pass any entries. And in the third case, when he had sent the bill to the bank for collection, that time what he had done was he had debited the bank for collection account. So that entry needs to be reversed by crediting the bank for collection account and debiting bank account, or in this case there will not be any cash account, because this is the money collected by the bank. So normally it will be credited in the account of the entity in the books of the bank. That means in the books of the entity it will be debited to the bank account. And in the fourth situation, when he has already endorsed the bill and that bill is paid by the acceptor to the person to whom the bill has been endorsed, then also there is no question of passing any entries, because he has already endorsed, transferred the bill to somebody else, and that somebody else will be receiving the payment. So in two cases, that is when the bill is discounted with the bank or when the bill has already been endorsed, there is no need to pass any entries in the books of the drawer. In the other two cases, he has to reverse the entries which he has put through at the time of the bill being received after acceptance. So in the first case, he has credited the bills receivable account. In the second case, he has credited the bank for collection account by debiting the bank account. And in the case the bill is dishonored, how the entries have to be passed in the books of a drawer. So what happens? The bill can be dishonored when the bill is retained by the drawer, or bill can be dishonored after it has been discounted with the bank, or bills can be dishonored after it has been endorsed by the drawer to somebody else. So in all situations, we need to put through entries in the books of the drawer. If the bill is dishonored, that means he has retained the bill and the bill is not paid on the due date. In that case, again he has to debit that person's account, that acceptance account, that is B's account has to be debited and bills receivable account has to be credited. That means you are reversing the entry which you passed at the time when the bill was received, and whatever charges are incurred are also debited to B's account. So B's account will now be debited with the amount of the bill of exchange plus whatever extra charges are incurred for that purpose. And when the discounted bill is dishonored, that means he has already got money from the bank, that time what happens? Again it will come back to the bill receivable account, has to be debited, and noting charges, because the bill is dishonored, it needs to be noted with the notary public. Whatever charges are incurred, that is also debited, and the entire cash account is credited. That means that money has to be paid to the bank. And B's account, again that bills receivable need to be reversed, because ultimately now the liability has to be put on B's account. So B's account is debited and then bills receivable account is credited and noting charges account also is credited. That means noting charges account is reversed. So now in the books of the drawer only one entry will appear in the name of B. There is a debit balance. That means this is the money which B owes to A on the dishonor of the bill. And when the bill which has been sent for collection is dishonored, then what happens? In that case again bills receivable account has to be debited, because we had earlier debited bank for bill collection account. So that has to be credited now. That means the earlier entry has to be reversed. Now a fresh entry has to be passed by debiting the bills receivable account, but again there will be noting charges. So that will also get added. So noting charges have to be debited, and to cash account also has to be credited, because whatever noting charges are there have to be paid in cash to the notary public, and ultimately these charges have to be recovered from B's account. So again whatever amount is debited to bills receivable account and noting charges account have to be reversed by debiting B's account with the entire amount. So when a bill is dishonored, these are the entries which we have to put through in the books of the account, that ultimately what appears in the balance sheet will be only debit balance in B's account. That means this is the money which the drawer of the bill has to receive from the acceptor of the bill of exchange. Now let us try to find out what entries are required to be passed in the books of the drawee when the bill is dishonored by him. That means the drawee himself is dishonoring the bill. So what happens is he has to debit the bills payable account and then credit A's account, and also he has to debit the noting charges account. That means that amount also is required to be paid to A. So whatever liability is created in the form of bills payable will get reversed, and to that we will be adding noting charges also. So the A's account will get credited with the amount of the bill of exchange plus the noting charges. That means that becomes the liability of the drawee of the bill of exchange to the drawer of the bill of exchange. What happens on the retirement of a bill of exchange? That means, as we have seen, retirement of a bill of exchange is payment of the bill of exchange before the due date. So in that case normally a rebate is made available to the person who is paying that bill before the due date. Therefore in the books of the drawer entries passed will be cash account to the extent the money is received will be debited. That means it will be actually the bill of exchange amount minus the rebate given, that is the money which you would be receiving from the acceptor of the bill of exchange, and for the rebate amount a rebate account is debited and the entire bills receivable account is reversed. That means it will no longer appear in the books of the entity. There will be only cash account to the extent the money is received and a rebate account to the extent rebate is given. That will be an item of expenditure in the books of the drawer. In the books of the drawee, there he has to pay the cash, therefore cash account is credited, and similarly debate he has got, so that is an income for him, so debate account is also credited and the entire bill receivable account is debited. Therefore he will reverse the entire entry. So what he has now got is he has paid the amount of the bill of exchange minus the rebate which he has got on retirement of the bill of exchange. In the case of a renewal of a bill of exchange, that means when the drawee is not able to pay the bill on the due date and requests the drawer to renew the bill for a further period, so that he can pay at the end of that extra period. So, in that case, normally what happens is the drawer will be entitled to receive interest on the unpaid amount. So, renewal of a bill can be part payment by the drawee to the drawer and the remaining part to be converted in the case of a new bill, plus interest on the portion not paid. All these are required to be added to the amount of the fresh bill. So, in the case of a cancellation of old bill, what is done is B's account is debited, that is the person, the drawee's account is debited, and bills receivable account is credited. That means bills receivable in the books of the drawer is reversed. It will now appear only as a debit balance in B's account. And when the new bill is issued, new bill will be for an amount which is the remaining amount which is required to be received from the drawee plus interest portion, and cash account is debited to the extent a certain part of the amount has been received from the drawee. If, for example, on a 100 rupee bill, if the drawee pays 30 rupees and wants 70 rupees to be converted to a new bill, so what he does is cash account will be debited with 30 rupees, that is the part amount received, and the bill receivable account will be debited with 70 rupees plus whatever interest he has to recover on the rupees 70 which is remaining unpaid. And that interest will be credited to interest account because that is the income of the drawer, and B's account will be debited with the remaining amount. That means B will have to pay that amount at the end of the maturity period of the fresh bill drawn. And in the case of a cancellation of a bill, in the books of the drawee, again he has to also pass the entries. There, whatever bills payable account he has created as a credit balance has to be reversed. So, he will debit the bills payable account for the total amount of the old bill. Then interest account also will be debited because that is the interest which he has to pay to the drawer on the portion of the amount which he has not paid, and then cash account will be credited for the amount paid because he has paid part of the amount, and for the remaining part, if fresh bill has been drawn, so he has to credit the bills payable account. So, the new liability in the books of the drawee will be to the extent of the amount of the fresh bill which has been drawn, which includes the remaining amount to be paid to the drawer plus interest on that portion. So, let us try to understand whatever entries need to be passed with the help of a simple illustration. As per the illustration, we have, as you can see, on 1/1/2012, X draws a bill of rupees 10,000 on Y payable after 1 month. Y accepts the bill and sends it to X on 4/1/2012. That means X receives the bill back on 4th January 2012. Y pays the amount on due date, pass necessary entries in the books of X and Y, that is both in the books of the drawer and in the books of the drawee. Let us first consider entries in the books of X, that is the drawer. When accepted bill is received on 4/1, so when the bill is actually drawn, then no entries are passed. Only when the bill is accepted by Y and received by X, that is on 4/1/2002, he will pass the following entries. One is bill receivable account is debited with 10,000 rupees, that is the amount which he has to receive, and Y's account will be credited with 10,000. So, that clears the Y's account. Now, only entry appearing in respect of the amount due from Y will be in the form of bill receivable account. When the bill is actually paid on due date, then he will be receiving the money through the bank. So, bank account is debited and the bill receivable account is reversed. That means bill receivable account will be credited. So, ultimately he has got the bank balance in the form of increased bank balance of 10,000 rupees. So, in the case of drawee, that is in the books of Y, when the bill is accepted, he has to create a liability in favor of the drawer. So, he debits excess account, that means when whatever credit he has already given when the goods he had received, that will be reversed by debiting excess account, and a new liability is created in the form of a bills payable account. So, bills payable account is credited and excess account is debited. and when he is actually paying the bill on due date, whatever liability is created in the form of a bill payable account will be reversed by debiting bills payable account with 10,000 and bank account will be credited. That is the amount of money which he has paid to the drawer, that is X. Now let us talk a little bit about the accommodation bill. What is the meaning of accommodation bill and what purpose it serves normally, and how bankers have to be careful about accommodation bills. As we know, accommodation bills do not reflect the actual transactions in goods. They are only accommodative in nature. That means without any underlying transaction, these bills are drawn in order to take advantage of the fact that bills can be discounted at the bank. So the drawer and the drawee in collusion can draw accommodation bills and try to get finance from the banks. Since this is an accommodation bill, both the parties have to be involved, because the drawer of the bill and the drawee of the bill, the one who is accepting the bill, need to be involved. So both will get some money. So there is no underlying transaction, and this is only to meet the financial needs of both the parties, in some cases only one party. And before the due date, what happens? The drawer who has got the money remits money to the drawee, and that money the drawee pays to the bank, which again pays it to the person who has drawn the bill of exchange. So this cycle can be continued with presentation of another accommodation bill. So normally banks have to be very careful about such bills, but as far as accounting treatment is concerned, it is the same whether it is an accommodation bill or a genuine bill. The entries to be passed in the books of both the drawer and the drawee will remain the same even in respect of accommodation bills. Now let us try to find out how the books are maintained. What is the format of bills receivable book and what is the format of a bills payable book. As you know, bills receivable book is always maintained by the drawer of the bills of exchange, whereas bills payable book is maintained by the acceptor of the bills of exchange. In one case, bills receivable is an asset in the books of the drawer, whereas bills payable is a liability in the books of the drawee. So there, if there are a number of bills received regularly by the drawer, he needs to maintain it in the form of a book, so that there is some kind of control over the bills which he has received and for which he has to get payment on the due dates. So as you see from the board, you can see that the date of receipt of the bill is mentioned, from whom the bill is received is mentioned, and who is the acceptor of the bill, what is the date of the bill, what is the term of maturity of the bill, that is the period of bill, what is the due date, where it is payable, at which place it is payable, what is the amount, and finally how it is disposed of. All these are mentioned so that it becomes easy for the drawer of the bill of exchange to keep track of all the bills received, whether they are paid on due dates or not, so that he can make regular follow up. Similarly, in the case of a drawee, he will maintain a bills payable book so that he can keep track of all the bills accepted by him, so that on due dates he is able to make payment of those bills of exchange. So as you see from the format, you see that the same thing appears in the case of bills payable also, only in this case it is, instead of the acceptor, we want to know who is the drawer of the bill of exchange, because the acceptor is the drawee himself who is maintaining this book. So we will have the place for the name of the drawer of the bill of exchange, then who is the payee, that means who has to receive the payment of that bill of exchange, what is the date of the bill, what is the term of the bill, what is the due date, and where the bill is payable, and what is the amount, and remarks column. So this is how bills payable book and bills receivable books are maintained in order to have effective control over the payment of bills on due date or receipt of amount on due dates.